Hello, everyone. Welcome to All In on Real Estate. I'm your host, Aaron Goins. I started this meetup because when I was in the military, no one talked about real estate. So I wanted to start a meetup where people can learn about real estate and start building generational wealth for them and their families. I'm very, very excited for our guest speaker today, Mr. Purcell Carter. How you doing, sir?
How you doing?
Good, man. Good, man. Good, man. This is a long time coming. I'm very, very excited to have you on here. And I can't wait to get started and talk about things we're going to talk about today. So let me ask you this question. And we'll talk about life insurance today for the most part and about his story. So let's start off with your story, man. Can you just explain your beginnings and to where you have to now?
My story is kind of like I bounced around a little bit, right? I went to school for engineering. When I got out of school, I worked in kind of like a construction field. I was a civil engineering major, worked in the construction field. And then, the market tanked and I was kind of in between like positions at the time. So I started contracting, just kind of looking for, a means to an end. I had a little girl and then the market crashes, right? So I found myself in a whole nother field, car sales. So now I'm just trying to reinvent who I am, what my purpose is, what goals I'm chasing. And, through all of these different changes, financially, it just is not adding up. I'm check paycheck to paycheck, trying to support, my lady and my first daughter. Then I have another daughter, and something has to change. I was successful as a car salesman, but it was just kind of like, I was just kind of like floating along. Within that, ran into someone who asked me to take a financial literacy course. And, in that course, they uncovered a lot of things that I saw in my community, especially with like life insurance, how, it just wasn't important. It wasn't important to protect our assets and things of that nature. Life insurance was more so geared towards a funeral. And that's probably like the last purpose of life insurance. So, within this financial literacy course, I ended up getting my license. But one of the most important things that I learned was that life insurance was the foundation of your financial structure. And what that means is, life insurance is the transfer of risk. And, the biggest risk is mortality. So if you pass away, how does that affect your family? If you don't have, something in place to replace your income or replace your financial, contribution to your family unit, then everybody suffers. So, that was like my introduction into life insurance and, what it can do for, future generations and, for the community that I came from.
That's what's up. That's what's up. So, for people who don't know, but what can you just go a little bit deeper into, life insurance and how it benefits for the next generation?
So everybody needs life insurance. Newborn to, someone that is, almost close to like their final days. Just because, it serves in so many different ways. If it's a newborn, you can use life insurance to plan for their future life stages like college planning or, setting them up for their first, down payment of their first home, right? Asset protection, you have life insurance just to make sure that your family is financially stable. If you pass away, they don't have to shop at the half off section in Walmart, right? Because there's no half off section in Walmart. If you pass away, everybody has to bear whatever that financial responsibility is. And but again, we're still looking at, the death benefit of life insurance. There's a whole other, nuance in life insurance that people don't understand, and that's leveraging the cash value and creating your own bank, or some people call it infinite banking. Some people say be your own bank, but it's a strategy that you can use. you can avoid taxes, and this is a tax code that actually supports it. So it's not like it's some kind of a loophole. This is just the way that the policy actually works. So it's very interesting to know that you can do these things, but a lot of people just, are addicted to tradition, and some of those traditions are what leads them to making decisions that end up being detrimental in the future.
Yeah, for people in real estate and things like that, I hear that, I hear about infinite banking a lot and things like that. But before we get into that, why do you think people do not try to get into life insurance? Where I think it's very, I mean, you everybody's going to die. You know what I'm saying? So I think you all need life insurance to not only for yourself but for future generations. So why do you think people don't get into life insurance?
It's accountability, right? So accountability is interesting. It's an interesting concept, right? You planning is an interesting concept, but being accountable for what may or may not happen, and then looking at it from the wrong perspective. A lot of people look at like an insurance premium as like a bill, right? They don't look at it as like investing into the future of their family. And it's not an investment. I don't want to say the word investment, but it's actually investing into your future, right? Investing into, if you have a critical, chronic, or terminal illness, how are you going to be able to take care of whatever your responsibilities are, right? Life insurance can provide for that. If your child wants to, if you're planning for your child to go to school, but let's say they don't go to school, right? If you had a 529 plan, you can't do anything with that, right? And there's nothing, I mean, I'm not gonna say there's nothing wrong with 529 plans, but it's probably not the best plan when it comes to planning for education, because every child's not cut out to go to college, right? You may have aspirations for your child to go to school, but if they don't go, now you got to figure out, how much are you willing to lose of that money that you've invested, to recuperate on that investment. Life happens to everybody, right? Some people just have a smooth life and nothing goes wrong, right? And when you have that, now you got to start looking at retirement and looking at the different risks that come along with retirement. So it's something that everybody needs, and when it's positioned properly, and you're looking at the money that you're putting to the side grow, then it becomes something fun as opposed to like a burden, right? I'm going to get it. I will get into like how that works. But I don't want to take over the conversation just yet.
Yeah. I know that, when I first started and I had my life insurance plan, and I was just like thinking like, man, I don't want somebody to pay for, I don't want somebody to pay for my funeral. I want to pay for myself. I want to pay for, and help my children out. And that was my whole passion for it. And then like getting into real estate, I got a whole new perspective of life insurance. And I know you're going to get into that in a minute, but what else do you think, another reason why you think that people are just so admitted? Because I mean, I think it's a no-brainer for anybody, especially if somebody who has, some kind of wealth. You want to have something, like you said, asset protection. I think that, everybody should, with some kind of money, have a trust as well. Because you just never know, what can happen, and you want your loved ones to have control of your assets as quick as possible.
So the thing about assets, right? We get these assets, right? And once they grow, we start treating them like eggs, right? It's like, oh, I don't want to mess it up. I don't want to lose it. I don't want to drop it, right? And to be honest, it is like an egg, right? Because your assets can be lost, they can be stolen, they can be swindled, they can be divorced, they can be decimated by the market, they can be wiped out by a long-term care situation. So you want to have it protected in a space where those things can't happen. And insurance products are ways that you can do that, right? So of course you want to build up, your nest egg, or whatever you want to call it, your retirement plan or just your savings or things of that nature. But insurance is a vehicle that you can put it in where it can grow and you don't have any risk associated with that, right? Associated with the growth, right? And when I talk about risk, I'm talking about like market risk. You know, if you have your money in a variable product and the market, you know, takes a downturn, then of course, you know, the asset that you have is taking a downturn, right? And you gotta be able to ride that wave, right? And the younger you are, you can afford, you know, to ride that wave because your risk tolerance is not as low. Or is not your risk tolerance is you know you can tolerate the risk. I'm sorry, is you got a high risk tolerance. But the older you get, you know, you can't afford to lose 10% of your savings, right? Or you can't afford to lose if you have a few different years of, you know, a down market, you know, that's devastating. That means you may have to work a little longer before you can retire, right? So those are concerns. The thing about life insurance is it is preparing for the future, right? It's not preparing for tomorrow. It's about making sure that you prepare for the future because nobody knows what tomorrow holds, right? And tomorrow could hold, you know, a diagnosis. It doesn't have to hold death. It could be a diagnosis that takes you out of the workforce, and now you are, I'm not gonna say necessarily a burden, but you are a non-contributing factor financially in your household, right? So if you don't have anything in place that takes care of that or helps out, now yes, you are a burden, right? So you know, life insurance is about future planning, but it can be fun. If you change your perspective about what you're actually doing, it could be really fun. You know, it could be exciting, actually.
How young if you had to do it over again, how young would you start to get into life insurance?
If I had to do it over again,
Mhm.
To be honest, you know, hindsight is always 2020. Um, I I would have gotten my first policy, you know, probably around 18 years old. As far as getting my license, um, I can't really say I would do it any other way, only because it took for me to go through different stages in life to understand the importance of what I actually help people do, right? So you know, I mean, I can make the fairy tale statement and say, oh, as soon as I was old enough to get a license, I would have got it, but I probably wouldn't have appreciated it if I didn't go through life and understand like now it's time to start, you know, preparing for the future.
Right. No, I'm saying I understand. I mean, I when I started, I got my life insurance policy. I think I was 32 or something like that. And it was somebody who I talked on the phone, USAA, and she's like, "Oh, you need life insurance." I was like, you know what? I got kids now. I really got to think about them, and that's what started for me to get into it. So, I definitely understand, the importance of it. Okay, so I think that we hit that platform as far as what the reason started for age and how important it is. But let's go a little bit deeper. Let's go a little bit deeper than that. So let's talk about life insurance as far as infinite banking. The floor is yours to talk about that.
All right. So what I'm going to do is I got to explain a couple concepts. Or no, actually, I can really just go into an analogy, right? So when you purchase a permanent life insurance policy, right? Because infinite banking can only be done with certain types of policies, right? It has to be a policy that grows a cash value, and it has to be a policy that has a flexible premium, right?
Mm-hmm.
Two things that you must have. I kind of don't want to go into that just yet, honestly. I want to talk about the different types of policies, and then I'll finish up with the infinite banking, right?
Floor is yours. Sure.
And so everybody, I'm pretty sure, knows about life insurance, and I don't want to make this boring. I want to make it exciting, right? So I'm gonna be really quick with a lot of small parts, and then when I get into like how you can prepare for your retirement and put money away and leverage it, and create your own bank, that's when I'll kind of get into a little bit more depth, right? So, first type of policy is your term policy, right? Now, term insurance, there's nothing wrong with that. It does not build a cash value. It is protection for a specific time period, which is a term, right? That's why it's called term coverage. It's pure coverage, right? It is what it is. You buy this policy, what you're paying is for the insurance itself, right? I usually help people with term policies when they're trying to protect like their mortgage, right? If they got a 30-year mortgage, I'll give them like a 30-year term policy. If that's what they want. And then term is also a little bit more affordable. However, term is like saying, I'm going to die on this date, right? And if you don't die by this date, then you've paid money for protection, but you don't have any kind of return from that. It's not a bad thing. You were protected at the time. However, once you get outside of that term, you still have to get insurance based on your age and health history at the time, right? And that means it's going to be much more expensive, right? So term has its limitations. It's a great thing, but it's limited. It's like renting coverage. And then you look at, permanent coverage, right? So whole life is a type of permanent policy, but it's really called permanent insurance, right? So under permanent, you have, you got whole life, you got universal life, index universal life. And with whole life and index universal life, those types of policies build a cash value, right? It's not something to be used as an investment. So I want to make sure that is not confused about how this is being positioned. However, you can grow a very lucrative nest egg through the policy. And the way that works is when you purchase an insurance policy, what you are buying is a death benefit. The product itself is a death benefit, right? Now, as you're paying premiums into this policy, a portion of that premium goes to some type of cash value vehicle, right? With an index universal life policy, it goes to an index account that grows based on the performance of a specific index. It's not on the market, but it takes advantage of market gains, right? You suffer no penalty for market losses. So if the market goes up, your money rises. If the market goes down, your money stays where it's at. So every time the market goes up, your money is increasing, right? With that, you can leverage that cash value against your death benefit. So I like to use the $1 million baby because this can go across the whole lifespan of an individual and how insurance can be used through those various stages of life, right? So, someone has a kid and they want to plan for whatever if they want to go to school, if they want to go to trade, whatever they want to do, you want to plan for that financially, right? So let's say you're putting some funds away, and the way that the policy has to be structured, it has to be structured where most of the premium is going to the cash value and it has a minimum death benefit, right? Because you're using the policy to accumulate cash, right? When you do that, when you look at your policy statement or your illustration, you'll see that, let's say you've put away $6,000 over the course of a year, maybe 4,500 of that 6,000 went straight to the cash value, right? So now that's funds that will always be there no matter what. As long as you don't pull it out as cash, that money will be there forever, and it's going to grow with compounding interest, right? So over the course of like 6 or 7 years, eventually your cash value will be more than what you've actually paid into the policy, right? And that's exciting. Now you're not looking at it as a bill per se. It's more like a glorified savings account that's still growing with compounding interest. Now, if you have some sort of situation, like let's say you want to do college funding, right? If you take a loan out in the policy, you leveraging your death benefit against the cash value, right? So let's say you have enough money to pay for your kids' college tuition. You take that out in the form of a loan. That means you don't pay taxes on it because loans don't get taxed. And if you never pay that loan back to the policy, then it only affects the death benefit when the insured in the policy passes away, right? You're never in debt. You don't owe anything to anybody, right? The interest is internal inside the policy. So, and remember, you overfunded the policy, so you're not going to default on a policy. So if you never pay that loan back, then when the death occurs of the insured, that's when that loan gets satisfied. And the way it gets satisfied is the beneficiary just gets a little bit less than what they would have gotten if you would have paid the funds back into the policy. However, if you pay the funds back into the policy, you're just paying yourself back and giving yourself another opportunity to leverage the cash value for another stage in life, right? So let's imagine that this kid, they get a scholarship. You don't have to use the college fund per se for school. Now you have funds to help them get their first home, right? A down payment on their first house, right? And you don't have to go to a bank, or you don't have to go into debt, or you don't have to use any credit to get access to those types of funds, right? And if you take those funds out, you use it towards a house, and if you don't pay it back, it is, you're not losing anything. It just diminishes the death benefit. But keep in mind, when you take funds out of a policy as a policy loan, it changes the death benefit and does not affect the cash value. So every year when this cash value is growing and growing and growing using compounding interest, these are like huge sums. Like imagine if it's $100,000 in the cash value and it has a 10% yield that year, that means it grew by $10,000, right? And over the course of like 10, 20, 30 years, that 100,000 becomes high six figures, maybe seven figures. So the interest that's accruing is tremendous, right? So if you fast forward into your retirement years, now you can literally create a lifetime income because the interest that is accruing on the cash value is more than you're actually taking out to live off of on the yearly basis. And that's called a tax-free retirement account. So that's the exciting part of insurance, right? If it's structured properly and you're not looking at it as, oh, this is going to pay my death bill, you should look at it as this is going to pay all the rest of the bills for the rest of my life without me paying taxes. And when you pass away, your family still gets a death benefit and you had a tax-free retirement. So that's the exciting part of leveraging life insurance in a proper way. If I want to associate this with like real estate investing, right? If someone has nice sums of money, right? You put your money into a life insurance policy, you structure it where as though most of the cash is going to the cash value. Now those funds are in a protected space. And if you need to leverage it for your next project, right, you can pull out money to do an investment or buy an investment property or do an investment project. And once you recuperate the funds and you put it back into your insurance policy, you can leverage it again. Now you have infinite banking. You can continue to do that. You take it out, you put it back. You take it out, you put it back. The whole time you're doing that, the cash value is growing with compounding interest, right? So I mean, this is it's a very interesting concept. Banks do it with your money, right? If you look up what kind of insurance policies banks have, they have insurance policies and they loaning you money based on the insurance policy, and the cash value is growing with compounded interest. So banks do it, right? Putting your money in a bank is probably the worst place because it doesn't grow and it can be swindled, it can be taken, it can be garnished. They can't do anything with your insurance policy. It's protected.
Yeah, good stuff right there. Good stuff. So going back on the real estate part, like I heard that like for instance, you can buy a whole bunch of real estate parts. I mean, a whole bunch of real estate, keep the debt low, take out all the equity out the house, out the homes, live off of it. And then when you pass away, life insurance policy that you could have could pay for it, pay for those assets. So now your next generation has those assets that, tax free. And, so that's a great way, for the next generation to, if they handle it the right way to build wealth.
One thing I'll say is, we have a consumer, we have a lot of consumer minded individuals in our population. And, when you talk about like financial literacy, the first thing a lot of people go to is credit. Credit is just the ability to incur debt, right? It doesn't make you really financially financially literate. It just makes you, you pay your bills on time, but you still may be financially irresponsible because you're not putting any money away. You don't have a emergency fund, right? You're not making your money work for you. If all else fails, if you don't have insurance, now your family is like, what are we going to do, right? And that's the thing, like, insurance takes all of the risk off the table, right? When it comes to longevity risk, it takes that off the table. Market risk, it takes that off the table. The sequence of returns, because you have a 0% floor, right? In your policy, like if the market goes negative, your money goes nowhere. It stays exactly where it's at. Or, it takes that off the table. Long-term care, a lot of policies have something called living benefits, which gives you critical, chronic, and terminal illness protection, right? And if you have a policy that is, or you can have a long-term care rider, specifically long-term care rider on your policy. But what that means is if you have, a heart attack, stroke, life-threatening cancer, cognitive impairment, severe cognitive impairment, Alzheimer's. If you can't perform 2 of the 6 activities of daily living, for a 90-day period, then you're chronically ill. If you get diagnosed with something that gives you less than 24 months to live or 24 months to live, depending on the actual carrier itself, like you can take advantage of the death benefit and you won't be a financial burden on your family, right? And it's no questions about it. All you have to do is have the diagnosis, and then you can say, hey, I need 300,000 of this policy to be able to pay my house off, or I need enough money so I can pay a caregiver to take care of me, right? These are the options, or the future needs that you'll have. It takes all that risk off the table. It takes mortality risk off the table. You can take taxation off the table. So, insurance is very powerful, especially when it's used properly.
Okay, so my next question for you is, seeing all that, is there any risk that that you've seen or you talk to people that makes them second guess getting insurance or life insurance?
I can't see why anybody wouldn't have any life insurance, right? So is this people would say buy term and invest the difference, right? So the reason why that is full of holes is because it doesn't eliminate the risk that these investments have, right? And there's nothing wrong with an investment. You should have your portfolio should be diversified, right? Keep in mind that, your financial planner gets paid whether you make money or whether you lose money, right? So it doesn't matter. And I'm not saying anything about their integrity, but, they went on both sides. They just, as long as they make something happen, they getting paid, right? You're paying administrative fees, if your taxes are deferred, you're just pushing your taxes down the road. And what if the tax rate is higher down the road, right? Was that a good decision? And that's speaking about qualified plans, right? But when you have a permanent life insurance policy and you get it young enough, right? Because the thing about it is you want to get it as early as possible, because the longer you wait, the more it's going to cost, right? Or the longer you wait, the less you're going to be eligible. And I mean, people can get insurance post cancer and things of that nature. Like a lot of times people feel like they're uninsurable, right? And that's always not true. They may be limited of what kind of coverage they can get, but you can get some coverage. But that ideal about buy term and invest the difference, one long-term care situation will totally eliminate your assets, right? If somebody sues or swindles you, it eliminates your assets. If you get, if you have a divorce, what you thought you may have had, it gets split down the middle. If you get divorced, they can't be like, give me half of the insurance policy.
Right. Right. Absolutely. Do you think that, I mean, I would hope, but do you think that with some of the bank crisis going on, that smart people are going to say, you know what, man, I really need to get me a life insurance and start moving my money out the banks into that? Do you think there might be a more wave of that with how that, they predicting the economy's going to go down, things like that? What do you think about that?
So the bank's money is in insurance policies.
Mm-hmm.
You shouldn't even have your money in the bank. The money you have in the bank should be your emergency fund, and that's it, right? Because you're not beating inflation. You're getting 0.5% a year on your policy. And if you have a high yield, right? High yield may give you like 3 or 5%. But if you put it in an insurance policy, insurance policies are getting like 7-8% returns on it, right? Even the worst ones are getting maybe like 6%, and it's protected. It can't be sued, it can't be swindled, can't be taken away from you, can't be garnished. So if you're smart, you will put your money in insurance, in an insurance policy, or inside, you would put it in an insurance policy, or maybe like a fixed index annuity, which also is an insurance product, right? Because that has a 0% floor, and that money can't go anywhere. And then if you activate it, you can activate a lifetime income out of it, and it'll last you. If they sprinkle some magic dust and everybody start living to 300 years old, your fixed income annuity, your lifetime guaranteed income annuity will still pay you whether the money's there or not. It'll continue to pay. So if they sprinkle some magic dust and we all start living for another 200-300 years, I would hope that everybody had a fixed index annuity with a lifetime income benefit, because then they wouldn't run out of money.
All right. Okay. All right. So let me switch it up real quick. And I'm gonna ask you, because I'm open up for questions for everybody else to ask. This has been a very, very good conversation. I think you educated a lot of people on this. I'd like to tell everybody else, this meetup will be on Zoom tonight. I'm sorry, on YouTube tonight. So just to hear the replay of what Purcell was talking about. And also, can you provide your information at the bottom in the chat? And I'll put the information of your information on YouTube as well, so that they can get a hold of you, talk to you about life insurance. Where do you see yourself in 5 years?
So on top of life insurance, I also, this is y'all probably gonna think I'm crazy when I say this, right? So, because I can do life insurance anywhere, right? I help seniors with Medicare plans, right? So every Wednesday, I go to a different senior community, and we may play like a game, bingo. We may paint, have a nutrition Jeopardy game I play with them. Just building relationships. So I don't ever want to not do what I do. It's to me, it's no stress involved. I actually feel like somewhat of a hero, because I know when all else fails, I'm giving people a plan that's going to protect them in the worst parts of, what could be the worst parts of their lives, right? Or the worst parts of their family's lives. So I'm unapologetic about, my approach. I'm very, transparent. I don't try to sell anybody anything. I just, show them what life looks like, right? I ask them questions like, what's your plan? Right? Not having a plan is a plan. This is my slogan, right? Not having a plan is a plan. It's just not a good plan. So what's your plan, right? Is it the no plan? No plan is a plan, but when you need something and you don't have a plan, now you're scrambling around. As opposed to if you put things in order and you need something, it's no scramble. It's like, oh, we planned for that, a couple of years ago. Let's enact the plan, and now we're good, right? And it's as simple as that. And until somebody cares enough to hold you accountable for the plan that you have or you don't have, then you won't have a plan, right? Unless you're just like the planning type, but most folks aren't. Everybody takes life for granted, and taking life for granted is taking life for granted concerning death. Nobody thinks about well, what if I have a heart attack tomorrow? Or, what if I have a stroke? What if I fall down the steps and have a critical injury? What if I get hit by a car and I don't die, but now I'm incapacitated? You know what I mean? Like these are real things that happen, So you gotta have something in place so that if those things happen, everybody's okay. including yourself.
So
So in 5 years, oh, I'm sorry, my crazy 5 year, 5 year. So in 5 years, I got two little girls, and in 5 years they'll be in college, right? So
they will be.
I can do what I do anywhere in the world, right? So I think in 5 years, I'm gonna try, and this is really like in my things to do. I'm gonna try to go on like a 1 year vacation, right? And it sounds weird, right? But I did the math. If it's an all inclusive and it's like $250 a day, that's like, I want to say it's like $90,000, right? For two people, right? Because I don't want to really be by myself. So like $90,000, it pays all my utilities, it pays for, all my food, they do your laundry. I wake up on the beach every day. I'm not in the rat race. I'm not hearing all this negative news, and I can still sell insurance policies remotely. But I'm changing like my view on a daily basis just to see how like that changes the stress in my life, right? And I mean, it's not really a goal. It's just something that I want to. I don't want to call that a goal. It's just something that I want to do and experience just to see like how does that affect, how is that going to affect me in my spirit, right? You know what I mean? Because a lot of things we do like are just based on tradition, and a lot of these traditions are just harmful to us. With our mental health, right? You can't get away. So that's something that I think I want to do in 5 years.
Yeah, that's $91,000 right there. $91,000 right there for one person. So you almost up there. You almost up there. All right, next question is so somebody who is starting off, let's say you're starting off in real estate, or just starting off in an entrepreneurial journey, what would you tell them?
Read. So if you want to being an entrepreneur, right? You gotta understand you have to be disciplined, right? You are everything, right? You are everything. And if you can leverage yourself and have people under you, like like for me, I'm an agent. If I had agents under me, then I can kind of override some of the things they do, and that's cool. That's not why I got into insurance, but read, right? Because you always gonna have good days and bad days, and the bad days are going to be learning experiences, and you got to understand that everybody has a bad day, whether you work for somebody or you work for yourself or whatever you're doing. But when you have that bad situation, you have to immediately do something that changes your focus to something that's positive, right? Find certain books that that feed your spirit, right? Like one of the books I really like is the Four Agreements. And the Four Agreements, right? It changes my stress level because it changes the way I look at things, right? So one of the agreements says, always do your best, right? So always do your best, even if you're not feeling good, right? If you give the 10% that you do have, right? You did all that you could do for that day. Tomorrow you might be able to do 200%, but if you're always doing your best, you're never going to look back and be like, I could have did more, I could have, should have, would have, right? So always do your best. Second one is don't make assumptions, right? When you make assumptions, you set yourself up for disappointment, right? When you have these expectations of someone else, or you think the situation is what it is because you assumed it, but it could be something completely different. Now you're putting energy out there that doesn't really exist. So don't make assumptions, right? Ask questions and figure out exactly what the situation is, right? Don't take anything personal. And somebody could literally come to you and call you everything but the child of God, right? To your face. They called your name and said it, right? But don't take that personal, right? Like that's that person's cross to bear, right? Whatever they're going through, that's on them, and I come from an area that's, a part of the world it's very confrontational, right? So, it's easy to take things personal, but when you take it personal and you let all of that negative energy transition into your spirit, now you're walking around with that negative energy that you had nothing to do with, right? That person woke up on the wrong side of the bed. You can go the other way. You don't have to prove your gangsterness or whatever you want to prove, and you can just go about a whole different way, right? Now if they put their hands on you, now that's self-defense. I'm not going to say like you can always turn the other cheek. You know, if somebody puts their hands on me, I'm gonna take that personal. I don't know, right? So it's ideal. However, you know, we can control how we react to things, right? And sometimes we take things personal that have nothing to do with us, right? And the last one is oh, what I said, always do your best. Oh, be impeccable with your word. Say what mean what you say and say what you mean, right? If you lie to yourself, then that's the biggest letdown that you can possibly have, because you're not even being honest with yourself, right? When you look in the mirror and you're looking at a liar and you lying to yourself, that puts so much pressure on you as a person, because now you either have to live the lie or you have to address the lie and be accountable for what you told yourself, right? But if you always are impeccable with what you say, if you always mean what you say and say what you mean and do what you say you want to do, right? Then you know you take a lot of stress off the table. So if you put those four things together in the way that you move, and you're gonna fall short. It's not like you can snap your fingers and this is how you're gonna live. But like when you have that way of thinking, right? And sometimes the negative will bounce off you. You don't even know it was there because you're not worried about assuming what this person is doing. And you're not taking it personal when this guy cuts you off in traffic. And I said I was going to do this, so I got to do this. I don't have time to worry about, I'm focused on what I'm doing. I'm not focused on anybody else. And I'm going to give it all I have today because this is all I have. And then tomorrow I give it all I have tomorrow, right? I'm focused on me. One thing I would say is selfish is not a bad word. I think, you know, in a lot of communities, selfish is used to guilt people, but you can't pour from an empty cup, right? If my cup not full, I can't afford to share anything with anybody, right? Because when you keep pouring out your empty cup, and when you get thirsty, who's going to share with you, right? So I mean, and this is the things that I've learned just being an entrepreneur is you got to keep your cup full, whether it's with mentally, whether it's financially, whether, you know, however, wherever you're at, you know, you got to keep your own cup full and let people take what's spilling over, right? So you should be selfish and make sure that you're full, and then you help other folk. You can't help anybody if you can't help yourself, right?
Man, good stuff, man. Good stuff. Good stuff. I definitely gotta have somebody hear that book, man. Have somebody read that book. I think that's some good stuff right there. All right. I'm gonna open this up for questions. Does anybody have a question for Purcell?
I have a question. My name is Lily,
Hey,
and I
Lily.
have enjoyed what you have said so far. I think one of our biggest obstacles or competitors is the mindset, oh, I'll get a job with benefits. I just want a job with, life insurance and health insurance, and I just want some benefits. How do you, how would you respond to someone with that type of mindset who doesn't see the value in having his own policy that he controls, but relying on employee benefits?
All right, so that's the relying on your employee benefits is the worst decision, in my opinion, that anybody can make, simply because you don't own the benefit and the employer owns all of your benefits. They can say, oh, we're not going with this health insurance policy anymore. We only going to let you get this much life insurance, right? But let's make it a real life situation, right? So let's say, I don't want to use anybody's name on here. So let's say Miss Jones, right? Miss Jones has all of these wonderful benefits, right? And she has a heart attack and goes into a coma, right? So they're gonna take care of her for a few months, but then the job has to make a business decision. Like, she's not working anymore, she's not doing anything for the company anymore. So at some point they're gonna cut her benefits, right? So 30 days after they cut her benefits, because you always have 30 more days of coverage. Now, she's not making any income. She may be getting some kind of like disability, right? But she's not really making any income. She doesn't have any life insurance, and she doesn't have any health insurance. And she's had a stroke or a heart attack, or she's in a coma. So now she's almost uninsurable, right? So what's the plan right there? Like, what is her plan? Because the job owned the benefits, and they say, well, you're not working no more. You're not paying into this. You're not paying into it anymore. And they make a business decision. And this is what they supposed to do. They supposed to make a business decision. So what happens, and this happens all the time. People have heart attacks, strokes, severe cognitive impairment, injury. It happens all the time.
Okay, thank you. That was a good answer. Thank you.
Then on top of that, nowadays people don't stay at their jobs long either, right? Like, I guess like 20 years ago, people stayed at their jobs for 30, 40 years. Now people 2 years here, 4 years there, they build their resume and then they leverage that resume to move to it. They index their resume, right? It's like indexing your resume. I'm gonna get a little bit of, information here, and then I'm gonna jump here, right? Or if you get laid off, COVID was a prime example of how benefits, what happened with them benefits. You was off for 2 years with a health crisis. That life insurance wasn't still around, So you should always have your own policy and overfund it, dump money into it. That way, if the worst happens, is enough money in the policy that it'll keep it active, right? And you still be growing compounding interest. After a certain while, you don't have to put any more money into your policy. There's so much money in it that the index crediting pays for the policy in and of itself. Now you have a self-funding retirement plan, or infinite banking structure, or college funding strategy, right?
Okay.
More questions? Hey, Purcell, put me on too. The host, make me a host again.
Let me see.
I made you the host. Anybody? Another question for Purcell? Roz, you got anything? I see you put something in the chat. You got anything to add on? I see, and you made a good point about layoffs and downsides. I mean, it's happening all the time.
I'm gonna tell you, Raza is like a mentor for me, right? Raza is a wealth of information. I recently met him, and when we talked, he just was kind of giving me a lot of just little nuggets of information and knowledge. So if anybody is way more bulletproof than I am, it will be Raza. He's been in the business for what? They're almost 30 years, Raza?
Actually, about 17 years.
17 years.
Yeah, 17 years. Yeah. But no, man, I just I had a comment, like, great job. Awesome stuff that you do sharing. And thank you for, having Purcell on. I mean, more people have to get educated about really owning their own assets, right? People in a JOB get mentally prisoned to work for the man and trust everything on them. Purcell was correct. I mean, there's no any surety of a job right now. People laying off. If Zoom can lay off people, that during COVID, Zoom was the most booming app that was ever there. And if Zoom can lay off people, what about traditional businesses? Walmart's shutting down, a bunch of brick and mortar. So if you are in a job, the whole mindset of, I'm going to go work for somebody and I'm going to have a pension after 40 years and I'm secure, locked in, that doesn't exist anymore. So that phenomena is kind of long gone. It was, I think, 20 years ago. Nowadays, there's no guarantee of jobs. It's fly by night. And so if you're expecting your retirement and your life insurance to be depending on that, then guess what? Now you got laid off at 55. Now you're going to have to pay for a new policy at 55, which is going to be higher rate. So you would have been better off at 30 getting something that is going to be there for life. So definitely owning your own deal. Also, when you own your deal, it's not the cheapest thing available for your job to get you, right? You can get a really nice Cadillac that's like fits you. So it's huge to have your own stuff. So
good stuff, Roger. And I definitely want to say, man, that you know, you got to educate, like you said, you got to educate, and we got to have this, get out this more to people, you know, and people got to really open their eyes and change their mindsets about stuff, because a lot of people have limited mindsets. And I saw an article that it was a town like 30 miles away from Chicago. The plant is closing down. It's a Jeep plant, and they're closing down because they didn't get the electric car contract. So not only did that Jeep plant close down, but all the other smaller, you know, parts companies are shutting down too, because the Jeep is moving away. So you know, those people now are stuck.
That whole town is stuck. That's devastating.
Yeah, Zena, you got a question? See your hands raised.
Yes, Purcell, you spoke often about mindset changes, and I'm just curious to know, since you have young children, what do you tell them? What gems do you, provide for them as they're growing to help condition their mindset towards ownership instead of, or do you, provide them with that, that mindset training of, you can have your own, you don't have to go into an employment situation unless that's your choice. So what do you tell them along those lines?
So I think that this generation coming up are just different, right? They're more dependent and more independent at the same time, right? They have more resources that's at the touch of their fingers. But we also, I don't know, it's hard, right? I have two daughters, and I try to push them as hard as I possibly can, right? I have a very limited window that I have influence over them until they go out into the world and they gotta, battle the world. So I try to hold them accountable for the things that they do and they don't do, which is really tough. It's really tough on anybody, because accountability always feels like a personal attack. It always does, no matter what, right? But once you can learn accountability, everything else in life, in my opinion, is much more easier, because you can accept what you provided or what you didn't provide, or what you did or what you didn't do, or how you reacted here, So what I would teach is be accountable for what you want to do, how you want to do it, when you're going to do it, why you didn't do it if you didn't do it, why something went a certain way. And then always be willing to go back to the drawing board and figure out a different way. People that are successful just fail more than other people. You bump your head and you just keep trucking. You don't bump your head and then go a different way. You figure out how to not hit your head right there again, but then you may scrape your knee. I have like a thought that, in life, the first lesson you have is like learning how to walk, right? So what happens is, first you on your belly, you're crawling around, you're getting, you're crawling, right? And then one day you'll stand up and you got a little bit of balance, and then you fall. But the first thing you do is you try to stand up again, right? And then eventually you take a couple steps, you put a few steps together, you're walking, and then you may trip and fall again, but you're going to get up, keep walking. Eventually you're going to be running, right? And that's the first lesson. But every lesson is that same lesson, right? So when it comes to like learning how to do math, or learning how to read, or learning how to write insurance policies, or learning how to sell real estate, or whatever you're doing, the first part of that, you're going to be on your stomach, crawling around, bumping your head, scraping your knees. You're going to get a little bit of balance, and then you're going to fall again. And if you quit that first time you fall, eventually you're never going to learn any more lessons because you quit, right? But if you are willing to fall, get up, walk, then you can run with whatever you want to do. You can run with real estate. You can run with insurance. You can run with whatever passion that suits your interest. And if you continue to learn how to walk in life, you go far. But some people, they stop walking at high school, right? Some people, they stop walking when they have a massive, real estate empire, right? It's how many times are you willing to learn how to walk? Because that's what everything. Nothing. You're never going to do anything and just run with it, right? Even if you run with it, you did have a few little stumbles and then like, okay, I figured it out, right? But you gotta be willing to, crawl a little bit, get your balance, fall, take a few steps, walk, run, and then start over again with whatever the next project that you have for your life.
Thank you.
Okay, so I'm going to end the meetup. I'm going to end the recording on the meetup. I'm not going to turn this off, but I just want to tell to say to Purcell, thank you so much, man, for enlightening us, for really just educating us on life insurance and how important it is for us and our families, our friends. This should go out to everybody, and I hope people really just take a deep thought about if they don't have life insurance or getting life insurance right away. Because like you said, I mean, there's so many instances that can happen. I mean, somebody can get ill. Like we talked about just a minute ago, somebody can lose their job. What's next for them in their lives and for them and their families, especially people depending on them. So I just want to say thank you so much. And like I said before, this Zoom call will go on YouTube tonight. And you'll see the replays of this, and also you'll see a clip in the coming days or week or next week or so of a good bit of what Purcell are going to say. So I want to say thank you to everybody. God bless you, and we'll see you next time on this meetup.